So welcome back to the channel, and in today's video what I'm going to do is I'm going to go through a couple of entry models and show you how you can get involved on the lower time frame and just get involved in the market. So first of all, what I've done in this video is I've drawn a couple of diagrams. So first of all, what I'll do is I'll go through the diagrams and then I'll go over onto the charts and show you on the charts. So here we have the first entry model here, which is a change of character with no flip. And then over this side, we've got a change of character and a flip. Some people will just take this entry model right here. But for me personally, I'm happy to take both. So it really depends on, your risk parameters and how you are in the market. It depends on how it affects your psychology, things like that. Some people, might not want to take just a chalk with no flip, because obviously with the flip, what you get is you get an exchange of hands right here with the the supply to demand interaction, and then if demand fails, that's when people will get involved in the market. Sometimes this could be higher probability, but for me, I'm also willing to take this kind of entry model right here with no flip. But like I said before, some people will look literally just for this entry model right here, and that's the only entry model that people do focus on. So first of all, as you can see in this diagram here, what's going on is over here we've got a higher time frame point of interest, so it could be a 15 minute, depending on what time frame you are trading. For me personally, it's usually the 1 minute. So my higher time frame POI a lot of the time will be a 15-minute zone. So let's just say, for example, this here is a 15-minute zone, and then what will happen is you will obviously, you'll have your alert set, whatever it may be, and once you have your alert set, you're just waiting for price to come up and enter in to your point of interest. So what's happened here is we've built up equalize, and we've got a little bit of inducement before the zone. It doesn't have to be equalized. It could be, just one single eye to be classed as inducement, for me personally anyway. And then what happens is obviously price runs through that inducement, takes out the orders, and then it comes up. You get a take of the high, a take of the low. And if you've watched any of my videos in the past, I've talked about chalk quite a lot. And change of character, and I've also got a video dedicated to chalk and change of character. So if you don't know what change of character or chalk is, you can go watch that video, and then you can come back to this video and learn from there. But yeah, what you get is a take of the high, a take of the low, and then you will enter on a point of interest, which is around here. And that's pretty much the the first entry model right there. And onto the second one, what you get is you get the same scenario kind of, and then what happens is you come out, you take out the inducement, you take the high, then you come down, and then you tap into this demand right here. What that does is then it gives you a reaction, it comes up, and then we get a fail of that reaction there, so a fail of this demand also. And then what you will do is you will enter on the flip instead of the extreme. So what I'm going to do now is I'm just going to go on the charts and just show you some some real life examples and how you can get involved in the market. In this example here, what I'm going to do is I'm going to go down onto the 1 minute chart. But the market is fractal, and it works pretty much on any time frame that you can think of. So this same kind of thing will happen on the 5 minute, it will happen on the 15 minute. It's up to you what time frame you do go ahead and trade. But for me, I will be doing the examples on the 1 minute chart here. So what you can do is if we just come over to one of the examples here. So as you can see in this video, we're not talking about POI. So this POI might not be a strong POI. It might not be a POI that I look to trade from. But the POI in this video is totally irrelevant because we're just looking at the entry model. So what I'm going to do now is, as you can see, I've marked up my POI, and then I've waited for price to come up into my point of interest. And then what I'm going to do is I'm going to drop down onto my entry time frame. And then as you can see, what's happened is obviously this is inducement right here, as you could see on the 15-minute chart. What's happened is we've come up, we've taken out the liquidity, and we've tapped into our POI. And then let's go and zoom in, and let's just see what's happened. So as you can see, what's happened right here is we have come up, we've taken the high. So we have the first part of our entry model, so that would be our change of character to the upside. What we've done is we've come down, so this would be our low. So as you can see, if I just draw it out, we'll just change this colour, we'll give it like a nice orange. So what you can see is we've come up, we've then had a pullback, we've taken this high, we've come all the way up, tapped into our POI, and then we've come down and we've taken the low of that previous low. So this would be our previous low, and then what I would do is I would mark this out, and do we get a reaction anywhere? And as you can see, this candle here just blows straight through this point of interest right here, this demand zone, which would be our flip. So in this example here, what we have got is we have got the entry model 1, the chalk with no flip. So as you can see, we take this low right here, so this would be our change of character to the downside. So chalk down. So then where would you enter? So for me, what I would do is I would just literally take this candle right at the top. You could take the whole candle if you want. You could take the whole candle. You could enter at the 25%, or you could also, you could bring it up and just enter off the wick. So as you can see, if we do get tagged into this trade, it will be all the way over to the right hand side here. As you can see, if we do enter on the wick, we would not be tagged in. So what you can do is you can enter at the open, enter at the 25%. It's entirely up to you where you enter. You can test this in your back testing. So if we enter at the 25% and just put our high above the high right here, that would be a nice 4.2 pip stop loss. It's not very big at all, and you would get, high risk to reward. So just delete that. So obviously what you would do is you would get a nice risk to reward on that trade there. In this example specifically, there's multiple, chances to enter. So what we've got, if I just show you, we've got a supply zone right here because this has come down, it's broken structure, it's taken liquidity, all stuff like that. So this is a decent point of interest to look to trade from. So what you could do is you could mark out this right here. So we've got this supply. What do we get is we come up, we get this high right here. So if I just draw it out, what happens is we come up, we pull back, we take that high, tap into our POI, come down, take the low, we come up, tap into our POI right here, and then we go and continue to the downside. So again, let's just change back to a supply. So if I just mark this out for you properly, so we've got this POI right here, we've got our change of character up on this inside bar, so a chalk up, we've got then a change of character down, chalk down, and then we've not really got any interaction either in this one, so this is more of an entry model type 1. So what you would do is you would enter on the extreme. As I said before, obviously it's up to you whether you enter at the open, 25%, at the EQ, whichever you choose to do. So if we enter at the 25%, put a stop above the high, and then target whatever your target might be. It might be the next 15-minute demand zone. You might target 5R, you might target 7R, you might target 10R. It's all stuff that you got to test out in your testing and just see what works for you. So again, you've got another chance to get involved in this, because what we do is we are here now, creating a supply chain. So we come down and then we come back up, tap into our point of interest right here, and this is quite a good example for the chalk and the flip. So what happens right here is, if I just zoom in a little bit more, so what we do is we come up in this leg right here, we come back, we take the high, take the low. So here would be our change of character up, so a chalk up, and then we get our chalk down right here, so a change of character down. We'll just leave that as it is. But what can you see after we get your take of the high right here? What happens is we come down, we get a reaction to this demand right here. So if I just mark this down, this wick here. So this wick and this candle here is what caused the break of the high. And then we come back down, we react to this demand right here, and then we push up, sweep this high right here, which is, it can be a confluence in your trade plan. A lot of people, if they don't get a sweep, they'll still enter on the extreme. And a lot of people, will just enter on the flip if you don't get a sweep. So that's all things that you can find out in your testing as well, what works for you. I don't want to tell you what to do right here because, it's all dependent on, your risk parameters, how you feel when you're in a trade, how you feel taking certain setups. But for me, what I would do is, I would look for the sweep before I get involved the majority of the time. And then what happens is you can, enter on the wick or just enter on this whole candle right here. Whatever, it's up to you. So what you can do, again, enter at the 25%, enter at the EQ, enter the trade right here, stop above the high, stop above the sweep high right here, and then, you can target whatever you want. So as you can see, this trade is an absolutely crazy trade. If I just zoom out. So in this example here, you've got 3 chances to enter the trade. You've got this first one here, which doesn't get tagged right over here. Depending on where you enter, you might not have got tagged. And then what happens here, you've got another chance to enter, because what it does is it comes up, taps into your POI, gives you your change of character, comes back up, taps in, and then away we go. But again, if you missed this and this, what you can do is you can get again involved in this right here. So in this example, we get the entry model type 2, we get a change of character, we get an interaction to demand, we get a demand failure, we get a sweep of the, this candle right here, and then we enter on the reaction sweep, enter right there, and then, price goes down. You'd be in this trade a couple of minutes if you target a 10R, and, you'd be in and out in no time at all. So what I'll do now is I'll go on and give you another example. So again, as you can see, the POI doesn't really make any difference in this video, but what I'll do is again, I'll go over this trade and just let's have a look, see if it's clean. So I'll drop down to the 1 minute chart, which is my entry time frame, come up, and then all we're doing is again, we're setting a an alert, waiting for price to tap into our higher time frame POI. In this obviously example here, it's a 15-minute POI. So what happens right here, so obviously we've got a point of interest, and then we come up. So what happens is we come up, we come down, but then we take that high again, and then we come down, take the high, take this low, and then we tap into our point of interest right here. So again, let's just go ahead and break this down. So what we do is we come down, but then we take the high again, and then we come up, take this high. So this will be our change of character to the upside. So chalk up. We then get the change of character down. So change of character down. And this one here is actually a good example because what I said before, obviously with the sweep of the reaction, if I just go ahead and break this down here, what we get is we get a tap into this demand here. If you can go ahead, you can mark out just a wick. So we've got a demand, or you can mark out the whole candle. It's entirely up to you. But for me, and just for purposes of keeping my chart clean, I'll mark out just a wick. And then what happens is we come down, we get a reaction right here. It pushes up. But for me personally right here, it doesn't really sweep, any high. So then what would you do? You would then enter on the extreme. So this here is the extreme candle. Depending again on where you enter is entirely up to you. So for this example here, I will enter around the EQ. So if I just actually just change it over to the 0.5%. So if I enter on the EQ, as you can see, we get tapped in pretty much to the pip there. Stop above the high, and then obviously you can continue down. So if I just zoom out, let's see what happens. So that would be the old entry model here, guys. So obviously you come up, you take the inducement, you take the liquidity. When you are driving into your POI, you get the change of character, you get the flip, but you get no sweep. So you enter at the extreme, you come up, you tap in. As you can see, we've got momentum in our favor as well. We come down, impulse, and then we get a nice corrective pull back into our entry, and then again we explode to the downside. So that's entry model type 2 if you like, but obviously you've entered at the extreme. You've got the interaction to demand and the demand failure, but the main thing here is you haven't had a sweep of any eyes on the reaction. So like I said, some people will look to get a sweep, and if they get a sweep, they'll enter on the reaction and on the flip. But some people, will obviously just enter on the extreme. So what I've got one more example. So this one's actually quite complex, and it's a little bit of an harder one because you'll have to be really, really quick in order to get involved in this. So what happens here is obviously we've come up, we've pulled back, we've come up, we've pulled back, and then we've got a take of our high. So we've got a chalk up. What's happened then is we've come down, we've taken out our low right here. So for me, like this area here would be my low. So we've got a change of character down. So we've got a change of character down already. You could obviously set a limit on the extreme here, but obviously as you can see, it doesn't come back and tag you in. You could take the whole sell to buy range. You could probably take it from this candle right here. So you could enter on the all sell to buy range, but let's just have a look how many pip stop loss that would be. So around here, if we wanted to get involved in this, it would be actually a 2.5 pip stop loss. So that would be a valid entry, a really nice entry actually. So that's valid to do. But what I want to show you in this specific example is obviously what we can do is you can also wait for the flip, which is right here. So if we just come down and, you know, this is the demand that we do eventually react to. So what a lot of people will want to see is they will want to see this low gone here. So they will want to see a full failure of the demand zone. But what some people are happy to do as well are they are happy to obviously come down, see the reaction, and then once you see the reaction, once the reaction low is then taken, they are then happy to get involved in the market. So if we just break this trade down here, what you can see is obviously we get the change of character, which has already happened. So for me, the change of character is the main bit of, you know, the trade plan and the entry model. But what you can see happens then is we come down, we react. What happens then is we come down, we take out the reaction low. So we've taken out, you know, this low right here. So then once you take that low out, it is then valid to then set an order. And then like I said before, you'd have to be pretty quick with this one because you get tagged in pretty much straight away with the very next candle, obviously depending on where you enter. So what you would do, stop above the high. For me, 1.5 pip stop loss, a little bit too low maybe. You know, my minimum is 2 pips. So 2 pips would be right there, which is a really nice stop loss. And obviously where you target is entirely up to you. So again, just to recap on this last trade here, what we've seen is we've seen us come up, we've come down, we've taken the high, we've come down, taken the low. What's then happened is we've reacted to this demand zone right here, we've come up, and then what's happened is the reaction low has then failed, showing us that supply is then in control. It's then valid to set an order. So, you know, some people are happy to set an order right here, and then you can get involved pretty much straight away. And then, you know, that's pretty much the overall entry models. And, you know, there's just a couple of examples there on how you can enter the market. The whole entry model is there for you to see. If you've got any questions still and you need a little bit of help or anything like that, feel free to drop a comment down below. You can also, you know, contact me on Instagram in my Instagram DMs. I'll get back to you whenever possible, and I'm happy to answer any questions. But yeah, without further ado, guys, I hope this video helped. I hope it provided a little bit of value, and I hope you took something from this. But without further ado, thank you very much for watching, and I'll see you in the next one.